Bill, I know you think that the sell-off in emerging markets has gone far enough. How are you looking to take opportunity in the EM space then?
Well, generally, I think our favoured area is Asia. I think there's obviously a lot of sentiment issues around investing in China or anything related to China. But I think, as your correspondent was saying, the Chinese policymakers probably have room to ease policy if they begin to be concerned about the impact being bigger on the Chinese economy than a lot of people expect it to be. So they've got some flexibility. I think within the rest of EM, a lot of the things that normally go with weakness in emerging markets aren't actually there anymore. So people talk about the dollar being strong, and yes, I know it's up a bit today, but actually the trade-weighted dollar has gone
flat since June.
Yeah, the trade-weighted dollar has gone sideways for 3 months, and yet in those 3 months, emerging market equities have continued to massively underperform the US in particular. And normally those two things, the dollar and the relative performance of emerging market equities, go pretty close together. And I think that if you don't believe that relationship's broken down, I actually think that EM equity has gone a bit far. And the commodities cycle is also very closely tied to this. And it's interesting that Brazil actually is a bit of a beneficiary to this. Let's take something like soybeans. US is a big exporter of soybeans to China. Brazil is the next most likely place to be able to benefit from the fact that the US soybeans manufacturers are unlikely to be able to move as much to China. So there's a lot of moving parts, but I actually think if the global economy is actually pretty healthy, which I think it is, and if the dollar does not appreciate from here, I think you have to look at some of the things that happen when that's going on. And I think EM equities fit into that, and I think some of the commodity complex does.
Right.